one of the things that we were talking about for the beginning of 2025 was to do these lunch and learns and try to make them really exciting and keep them in front of people, because I think we did really well last year with informing people of things that are going on in the stock market world. So they asked me and Robert to come up with the most exciting and interesting things we could come up with. We put our heads together, and you all get to learn about account statements today. So we'll go ahead and jump straight into it. So this is what your account statements look like when you get them in the mail. As you can see, it's weird not being up there in front of it. Let's see, here we go. So as you can see, year to date, let's start up at the top. Right here, this is what your balance would be. We're time traveled. We're back in June 30th of 2024 here. We have $1.2 million in our investment account, and it looks like at the beginning of the month, we started off with 1.22. So beginning of the month, end of the month, looks like we've lost about $10,000. Then you come down here and you can kind of follow through where that money went. So year to date, it looks like we started off with $1.198 million. We've withdrawn $46,200. So that's going to be, the money that's coming into your bank account from your investments. That could be RMD, that could be monthly distributions, biweekly distributions, anything like that. Made $19,606 in dividends and interest. Looks like we've transferred in $23,000 worth of stocks, bonds, mutual funds, anything like that. And then market appreciation over the course of the year, we've went up $26,983. And then looks like maybe paid $4,000 in expenses. So that would be fees to us, things like that. So that was for year to date. So as you can see, year to date, we've gone up right around $19,000 here. This section right here, that has to do with what's gone on over the last month. So as you can see, everything still means the same thing. We took out $3,000. We've made almost $5,000 in interest. And it looks like the markets went down $12,000 over that time. So these numbers are actually included in the year-to-date numbers. It's just over the last month. So as you can notice, over the last year, we've gone up 19,000, but over the last month, we've lost 10. That doesn't mean you've lost 10 since the beginning of the year. That's just over the last month. We've still gained our 19 for the year. So I found a funny slide that reminded me of some of you all. Why is it going down after it's shot up so much? That's one of the things we find a lot is, it's been down over the last month. Looking at it over the big picture, or do we want to pay attention to the month, or does it matter more that we're sticking to our plan and it's lasting over, the year-to-date numbers? And that was just my attempt to make that a little bit more funny than it could have been. So this is the part that I find the most interesting. So this has to do with your asset allocation. So as you can see up here, this account, our account that we're working on, has about 2% in cash. So that could be just the amount of money you have literally in cash. It could also include your mutual funds that are money market mutual funds. So a lot of you all have SNVXX, and that would fall into there. Fixed income security. I'm so sorry, you're not supposed to click. Fixed income security, so that's going to be your bonds, mutual funds. That's going to be your mutual funds and your exchange traded funds. Those are your ETFs. And stop me, we have such a small group. If any of you all have any questions, just yell out at me and so as you can see, all of this will add up to 100, and you can see where your actual allocation is. So for here, the main thing on this that you would really want to pay attention to is the fixed income. The majority of what we do here, our mutual funds and our exchange traded funds, for the most part, are going to be equity. We do have a few that are mutual funds, and if you ever want to, we can go through this individually for yours. But the fixed income amount, that's kind of how I gauge how conservative an account is. That's your bonds. You're going to have, this account at minimum has 42% of its account in fixed income securities. Then, so we good on that? That was a little, okay.
Well, Mark,
Yeah.
define an exchange traded fund.
Yes. So an ETF how familiar are we with mutual funds? We can start there. So a mutual fund is something that you can invest in that has multiple underlying securities in it. So if Robert and I came up with a mutual fund and we said we wanted to have 20% in Apple, Microsoft, NVIDIA, Amazon, and Google, that would be our mutual fund, and you could come in and buy that mutual fund, and you would have representation with those underlying stocks. An ETF is very, very similar. You're going to be buying it and owning what that manager decides to put you in. The primary difference is how they're traded. Mutual funds, if I were to buy, Peter a mutual fund today, it's not actually going to show up in his account until the end of the day. And what it's going to do is they're going to add up all of those stocks that are inside of the fund, figure out what they're worth at the end of the day, and that's called the fund's net asset value. Adds it up, and that's going to be what the mutual fund's worth. It doesn't matter how much we bought or sold that mutual fund. That doesn't affect the price. It only has to do with what the underlying investments are worth. An ETF accepts the exact same thing, except we can buy and sell it intraday. So we could have the same ETF that has those same 5 stocks in it, but instead of having to wait till the end of the day for it to show up in your account, we could buy it and show up immediately. And it will trade throughout the day too. So if I buy an ETF for $100, it could be halfway through the day, it'd be at 92, and by the end it'd be at 105. Where if you're looking at your mutual funds, they're going to be steady throughout the entire day. So it's really, what it is, it's a vehicle to be able to diversify what you're getting into. Instead of, buying Microsoft, we might want to have access, or we might want to be allocated to the entire tech industry. And an ETF would be an avenue to be able to do that. So in the mutual fund example, let's say me and Robert are running that mutual fund and we decide that Microsoft doubled in value. Well, if we sell it, that creates a capital gain. And what we're going to do as mutual fund people is push that capital gain onto our investors. So at the end of the year, you're going to get a statement, and Robert will go over this with you all here in a little bit. You're going to get a statement saying you received X amount of dollars in capital gains from Brian and Robert's mutual fund. And that's going to go on your tax return as if you sold those positions. An ETF doesn't have that. They can buy and sell their underlying positions all day, and they don't push that on to people. So what ends up happening is if you are in a qualified account or a retirement account, mutual funds aren't as big of a deal because the capital gains aren't taxable in a retirement account. But if you have an individual account and we're trying to manage around the tax implications, you're probably going to want to avoid mutual funds. And that just means, so that way we're not ending up with any unintentional capital gains and we can manage around your tax situation a lot better.
Do you mind if I step in a second?
Yeah.
So through the mutual funds, the people who run the mutual funds, they make the decisions of when they take capital gains. With the ETF, you're given the choice whether or not to sell out of that position and take the capital gain. So it's easier to manage the tax consequence for that particular vehicle because of how it functions, where the dividends from all of those securities inside of the exchange traded fund are paid out quarterly and you get qualified dividends. But you don't have to worry about those capital gains from redemptions and from whenever those securities are sold within the mutual fund affecting you until you sell the ETF itself. So it's better for managing the taxes within a taxable account.
We have the income summary over here. So what this is it's just showing you the money that's come in through dividends, through CDs, through treasuries, through municipals, even money that came in through your cash balance up here. So as you can see over the last month, that 2% paid $1.49. the dividend or the cash dividends. So this is all the stocks that paid dividends and that came in cash, 4,824. Had we had CDs in the account and they paid, it would have ended up here. Same with treasuries and same with municipals. Then you come over to this side and this shows you what the whole year looks like. So it's interesting. So here's the $19,184 of income that we've received plus the 4,021. And if we go back, that's that number. So as we go further into it, you'll see that this is actually mostly explaining what's going on those first few pages. Over here, this is going to be your top holdings. A lot of people, this will be a lot of times where your ETFs and your mutual funds do show up because we're able to put a larger percentage into those compared to your individual stocks. But according to this one, we have 182,000 or 15% of ours in this dimensional U.S. core position. We also have down here the gain loss summary. So this is just showing you we've sold $1,815 in long-term gains. And we have currently 167 in unrealized gains. So that means if we were to sell everything in your portfolio, this would be the gains that would show up inside of it. Any questions on that?
That's not taxed yet.
The unrealized gains are not going to be taxed yet. Your realized gains could be your realized gains would be taxed at the end of the year.
Is that the total income?
Total income? So yes, right up here would be the total income for the year. So that's dividends and interest. Down here has more to do with what we have sold, what capital gains you've made inside of it. So this is dividends and interest. This is how much my stocks have grown. And then this is how much of that we've realized, and then how much of it we have that's still there that we haven't sold yet. And then we have the margin information here. Margin information, I actually had to go and look some of this up because it's not something I typically look at with my clients. But this is simply showing right here the rate to borrow money to purchase securities. It's charged by Schwab. So that's kind of what you would be paying in order to borrow money from Schwab in order to buy things. And it shows we didn't have any margin balance at the beginning. We didn't really at the end, but we have the ability to withdraw extra money or to purchase securities on margin if we want to. This is another sort of summary of what's going on. It shows the amount of money that we started with, just like on the first page. It shows the amount of money that was transferred in or out. So that's, if you have your RMD and you wanted to send it out or whatever, that's going to show up there. The amount of dividends that are being reinvested, the cash activity, the changes in the market value. So that's how much your stocks have gone up and down over time. And then where it ended up. So that's showing that $10,000 drop that we saw at the beginning for the month. And then we see the unrealized gains again. And then our cost basis in it. So theoretically, we started off with $1,026,000, and we've grown it over however long to this, the 1.22. We also have the cash investments. The bank sweep right here, this is where the cash goes after it's deposited. It's paying about 0.45%, and it is FDIC insured. What happens then is, so that's the brokerage one. What happens then is we'll a lot of times, if it's planning on sitting there for an extended period and we don't want it to drop in value, but we want it to pay more than the 0.47%, we put it in this SNVX. We use SNVXX. They're using SWVXX, which is the same vehicle, it's just different preference to who can buy it. But anyway, this one right now is paying 4.07%. And so we're using that as a place to hold cash right now until we have a position to buy or the money's distributed. It makes it to where you're not sitting there on cash, not making anything, but it's safe. This is your fixed income section. So when you're going through here and you're trying to figure out what your bonds are doing, this is what you want to look at. You've got the CUSIP, so that's just how it's identified in the system. The description of it, so this is a U.S. Treasury. How much it's paying on its coupon. So if we were to buy this when it first opened up and the initial offering of it, it would be paying 3.25%, and it matures in 8/31 of 2024. This shows how much of it we've gotten, how much of it, what the price of it is. And this part's actually interesting too. You have to move the decimal around a little bit for the math to work. But if you have 88,000 shares of this U.S. Treasury and it's pricing at $99,625, the value of it is $87,670. So think of this as almost as a percentage. If you multiply 88,000 times 99.625%, you're going to end up with this amount of money. The adjustments to it. This shows you that it looks like we bought it for a little under par. And as of right now, it's paying a little bit more than its coupon rate because it is trading at a discount. We're expecting it to make us $2,860 this year. And we've already accrued $955.92 of that. And it makes up 7% of the account. And what you do is you can go down through here and look at each item, and you can kind of see where bonds are pricing at. So in this example, it looks like we were coming off of interest rates were coming up. So almost all of our bonds are going to be pricing at a discount relative to where they're going to mature at.
The one thing I'd point out on bonds is that's a matrix price. So unlike stocks where there's an active market, where you know at the moment Google's trading for this.
That's a really good point. So when you are looking at it, let's say you got this as statement today and you're like, actually I need $87,000 because I'm renovating my house. Even though it's pricing at that level, that doesn't mean someone's necessarily willing to buy it from us at that level. That's just what Schwab is guesstimating it is worth. So what really depends on what we get is what someone else is willing to buy. If I have something that's, if it's $88,000 and I can get a 4% coupon out there, if I can get something paying me 4%, why would I buy something that's paying me 3.25%? Mm-hmm. You wouldn't. So the demand for this particular bond has went down, and it's reflected in the price here. So now when we go to buy this bond, it's actually going to be paying 3.48% compared to the 3.25. Mutual funds, so very, very similar. We've got, can't see it a little bit there. We've got DFA, Diversified Fixed Index Mutual Fund up here. And if you ever want to look it up, a quick way to do it would be to just look up that ticker symbol and not push the click button on. There's the quantity of those mutual funds that you own. So you own 965 of this mutual fund. It's currently pricing at $9.15, and that's not going to change through the day because it's a mutual fund. Its value, this is the total value of it and the cost basis of it. So we've lost $942 on this particular mutual fund because this is where we bought it and this is where we could sell it at right now. And same with the rest of them. This is very, very similar. So see, this is the exchange traded funds, the ETFs. Same quantity, price, market. So it's quantity multiplied by the price equals the market value. We paid this for it. So the difference is $11,000. We're expecting it to yield 7.86%, which would be $7,515, and it makes up 8% of our account. And you can go through each one of these too. And then transaction details, this kind of shows you what movements have been made in your account during that time frame. So it shows the date here. So on 6/17, let's see, there was $1.49 that came in from the cash that was there, and $83.72 that came in from the money market fund. And that's the actions that happened on that account that day. Looks like on the 6/20, we had cash dividends from all of these, and you see how much each one of them paid there. So a lot of this, you're going to leave here and go, okay, none of that stuck. But hopefully you'll get your first statement and you'll see something, and that's when you call me up and say, okay, re-explain this to me specifically, and we'll go through what that meant to you and what exactly happened. But I really think that understanding this is a good tool to understanding what's going on in your account and with your money. Even if you're not watching it on a day-to-day basis, being able to get this and say, okay, I skipped to the transaction page. I was curious how many, which one of my stocks paid dividends that month. You can see it here. I want to make sure that something was traded. Okay, that shows up here.
Well, Brian did such a good job of going over financial statements. And honestly, the tax document that we're going to be discussing is really just an annual document for all the income that was generated in a taxable account. That's what we're showing up here. There are other tax forms than the one that we're showing here on the screen. You're probably more familiar with the 1099-R, which is the form used for retirement account transactions, whether they're distributions or conversions. There's a 1099-SA for your health savings account. There's a 1099-Q for 529 accounts for education. So all of the tax forms that come from Schwab will have a 1099 in them. But we get the most questions about this particular one. This is actually a consolidated stack of 1099 forms that come from a taxable account. And so essentially what you have here is a 1099 DIV for dividends, a 1099 INT for interest, a 1099B, and I don't know what the B stands for, but what it shows is the capital gains transactions within your account. And there's also a 1099 MISC, miscellaneous, for miscellaneous income, which is actually kind of interesting. You can have a publicly traded partnership or oil and natural gas interests that are generating royalties that will show up on that miscellaneous statement. So it's a catch-all statement.
That's the lottery one.
That's right. Yeah. That's the complicated one for me because I've got to track it down and figure out what's going on, right? So the very first page is the 1099 DIV, and this is for dividends. And we like dividends because they are tax advantaged. If you hold the security for longer than a year, then that dividend becomes qualified and it's taxed at a lower tax rate. So we like to have securities that are paying out these qualified dividends with lower tax rate. Unfortunately, we have to hold on to the security for that particular time. So what we see here on line 1A is just the total number of dividends. And then it's broken down into the amount of dividends that were qualified that get that beneficial rate. But at the same time, this tax form keeps track of your mutual funds that are distributing capital gains. And so that's line 2A right there. And so that $1,575 is off of the mutual funds you had for that particular year. And the benefit of the capital gain distribution is it's taxed at that beneficial rate too. So it's treated like it's a long-term capital gain that we'll talk about later. All of these, the recaptured Section 1250, all of these are exotic things that, each has its own consequence, but we don't see a lot of that, and there's really no need to go over that. I will say this line 5, the Section 199A dividends, usually this is associated with real estate securities, real estate investment trusts. This allows you to have what's called the qualified business income deduction, which is 20% discount on taxes from that particular income. So we like to see that. And then you're going to have a certain amount in your account for a diversified account in foreign income. And so we'll see foreign taxes that are paid on that foreign income. And that's definitely something that you want your tax professional to report, because you can get a credit for the foreign taxes that are paid on that income. Line 11 is exempt interest from dividends. So if you own a mutual fund or an exchange traded fund that holds bonds for municipalities, that income is totally tax-free from a federal income tax perspective. So all of that tax-free income is going to show up here on that line 11. So we like to see a lot of that for those that benefit from that particular tax advantage position. And then the only other thing that I would show you is line 12, specified private activity bond interest. So with municipalities, you can have special activities that are financed by that, and it has a benefit for state and local tax purposes. So for our clients that are in Virginia or in some other state that has a state income tax, you can have a benefit for those types of things. But for those here in Tennessee, we really don't benefit at all for those special activities. We're just looking at that exempt interest from the municipal bonds. I'm sorry, Joe.
Those untaxed income that you were talking about, that still goes, they still count that towards your Medicare and the term and and all that, right?
They do, yeah. They include that with that. It's just that you get a federal income tax benefit for it. So
you pay on one place.
That's right. There's special rules for everything, and they make it complicated. So you have people like us to discuss this stuff.
What would you be doing today if they didn't put that?
Well, the next page is the interest page, and you guys are familiar with this with bank account forms. The complicated aspect of this from our perspective is that we're going to have some clients that have U.S. saving bonds that you get a benefit from a state and local income tax perspective. But with the transactions that occur when Peter and Brian are managing accounts, sometimes they buy bonds at a certain discount that then can be used to reduce the interest generated from that bond. And so on this particular form, it shows me when those things have happened. And so on line 11, the bond premium, because they bought the bond at a particular price and the income is a certain amount, we're allowed to take a discount on the interest because of that. And so when I'm looking at these tax forms for my clients and preparing, tax returns, I want to make sure that I get every single thing on that tax form that will benefit my client. And that's included on line 11 for the bond premium. and I won't go into the complications on the other stuff. It's more exotic, but I see this because AFI does what it does when it buys individual bonds, and most people in the country don't buy individual bonds like we do because of how complicated it can be. But because we do that, there is a certain tax advantage for doing what we do. And I make sure that our clients that do tax preparation through us get that benefit. Now, here's the miscellaneous that I was talking about. And I just show you this because we did have some oil and natural gas interests that we were invested in with some of our clients, just so that you're aware of it. The royalties there on line number 2 would show up there, and then I would put that on Schedule E as royalty income. And then sometimes there can be exotic things with the bonds that we buy if they're what's called a reverse convertible, but I won't get into that stuff. But I'm well aware of these things on the tax form to take advantage of those things. And the next part is the 1099B. And this is where we show when we buy stock or we buy an exchange traded fund or a mutual fund and then we sell it, this is where capital gains show up. And there are different types of capital gains reporting to the IRS. There's most often box A, where Charles Schwab keeps track of the cost basis, how much we invested in that particular thing. And then they keep track of how much it sells for. And then we have the reported gain here in the realized gain and loss column. That's not always true. Sometimes we have securities that come from other institutions that we bring in, and Charles Schwab doesn't want to say whatever we put down as the cost basis is the cost basis. So it'll go into a different part of the form. But we keep track of that here. Whenever we bring something from another institution, we get information from our clients, we keep it on a spreadsheet, and that way it's very easy for us to buy and sell in your account, keeping track of those things. Now, so box A is a short-term transaction. That means that we've only held on to that thing for less than a year. And that means that whatever gain there is, that's going to be taxed at your ordinary rate. The best thing is to wait and sell it when we've held it for longer than a year so that it's taxed at the beneficial rate, the capital gain rate. So usually what we see in this side from our accounts is usually the fixed income, where we're not generating a lot of capital gains in short-term transactions. And what we're doing then is we're holding on to those things so that it's longer than a year, and then we're selling it at the discounted rate. And so we have here the box D, where Schwab is reporting the cost basis here of how much it costs to purchase that particular security. And then here are the proceeds for that. And then we have, this particular thing had a $2.87 gain. This had a loss of $62.92. So when we're selling things, our anticipation might not have worked out. So we're selling whatever there are gains against losses, and we're harvesting losses to balance out the gains so that we're mitigating the tax impact of those transactions. And this is here on Form 1099B, both with Box A and Box D, you're seeing, what exactly happened and how we're minimizing those taxes in the account. So here, the total long-term proceeds are $4,371.55. The cost basis, or our investment cost, was $4,573.98. And we've lost this $61.80. We'll be able to take that loss against our regular income on a tax return all the way up to $3,000. And so it can be a benefit to go ahead and take advantage of those losses when they come, whenever we want to get out of a particular position for whatever reason, or whether we want to generate cash for a particular reason. Now, so here, this is the back end of the tax form.
Just real quick too, just before we move on, those A and D, and it's like A, B, C, D, E, F, there's a whole bunch of them. One transaction can appear in multiple ones. So if you have a mutual fund that's reinvesting, on a monthly basis, and you go to sell it, well, everything that was reinvested in the previous 11 months is going to be in box A, and then the rest is going to be in box D. So if you're looking for, hey, Peter or Brian told me they sold $10,000 of that fund, and you can't find a $10,000, sale, it's because it's time frame determined on there. Even though we only placed one sale, they're reporting it as each tax lot. And that's why, I think on the first page, there was one that said various on date acquired. Probably either a monthly or a quarterly reinvestment that had to be treated as a Schedule A, and then the bulk of it's going to be down in D. So it's really hard to take a transaction and pair it exactly with these forms.
And what he means by the monthly thing is, a lot of times these mutual funds will pay dividends, and instead of them showing up in cash in your account, they'll just rebuy fractional shares of that mutual fund. So it looks like you're buying a little bit every month or every quarter, when in reality you bought it once and you're just letting it reinvest.
So the back end of the tax form here, it breaks down all of the information that was consolidated in each of those previous tax forms. And it shows you exactly what happened for each of the securities in your account. So here at the back of the form, we're able to see, okay, this Asia Pacific Fund generated $960, that there were adjustments of $335, and so the total income was here, the $625. And so we're able to dig into each of these different securities and see exactly what it generated for that particular tax year, which can be beneficial because some of these securities hold U.S. Treasuries that, we can take a certain percentage of this income and then take a discount on our state and local income tax returns based on that, because there's, in Virginia and different other states, you can take a certain amount of Treasury income out of your total income for state and local income tax purposes.